Good afternoon, and thank you for coming to the Master Investor Show. We're delighted to be the lead sponsor of this great show again this year, and I trust that you're enjoying it, and the loads of good stands, loads of good speakers. I'm sure you're getting lots of fantastic food for thought on your investments today. Now, today I am going to talk about the UK market, investing in the UK market, and I'm going to attempt to answer the question, is now the time to buy British? But a well-diversified portfolio, of course, will only include some UK shares as part of it, some UK funds. And I'm only going to talk about the UK today. If you're interested in my thoughts on other markets around the world, then please do join me online on Tuesday lunchtime, 12 o'clock, when I'll be presenting my quarterly investment outlook. It's an online Q&A session. Fidelity.co.uk is where you'll find it. At midday on Tuesday, you can come online and ask me any questions you like about any markets around the world. So I look forward to seeing you there. And if you pop along to the Fidelity stand today as well, we'll make sure we take your details and we'll make sure that you receive my investment outlook via email. And also you can sign up to receive online investment insights and commentary from me and the rest of my team at Fidelity. So please do that. Get a nice cup of coffee at the stand and talk to our relationship managers. And if you're at retirement or in retirement, then we have some retirement experts there as well. So apologies for this slide. Apparently shares can go down as well as up. I need to tell you that, apparently. Let's move on. Okay. So, as I say, I'm focusing on the UK market today. What have Robert Maxwell and Dad's Army got in common? Well, the answer is a patriotic catchphrase that caught on in the late 1960s, when the UK economy was undergoing one of its periodic crises. We've had plenty of them, and I'm backing Britain became a rallying call to get us back on track. I'm backing Britain was actually a catchphrase which was formulated after 5 secretaries in Surbiton said that they would come into work half an hour early and work for nothing for half an hour. And they were doing this to back Britain. Harold Wilson, who was the Prime Minister at the time, thought that this was a wonderful idea and backed it. The unions were less convinced. They thought that more work for the same amount of pay was probably not a great rallying call for their cause. But anyway, I'm backing Britain became a popular catchphrase, briefly, and it spawned a few copycats, and one of the copycats was Buy British. And Robert Maxwell, this was in his pre-mirror owning days, caught on with Buy British, and he used it as a way of promoting Pergamon Press, which was his publishing business at the time. There was a problem with Robert Maxwell's call to buy British, and the problem was that the scientific journals that he published were actually printed in Eastern Europe, and the T-shirts which he sourced to promote Buy British were made in Portugal. So it was a bit of a disaster in that front, and was therefore rather short-lived. The connection with Dad's Army is that Dad's Army, with which many of you will be familiar, of course, started in the late 1960s, and the very first episode of Dad's Army had a flash forward from the Second World War to the late 1960s, and the Wilmington-on-Sea I'm Backing Britain group featured in the first edition of Dad's Army, and of course, who was in charge? The ridiculous Captain Mannering. So 2 ridiculous characters, one rather short-lived catchphrase, I'm backing Britain or Buy British. And of course, buying British is something which, we do rather less frequently than maybe we should, or maybe we did. We drive German cars, we watch Korean televisions, we communicate with each other on American phones, which are made in China. But there is one area of our lives where actually we do buy British, and we buy British probably rather more than we ought to. And that is the area of our personal investments. Now, I'm quite sure that many people here will hold UK shares or they will hold UK funds. I suspect that many people here will hold rather too many UK funds and UK shares. The Investment Association, which is a kind of trade body for the fund management industry, tracks the holdings of funds and shares in the UK retail market. It's about £600 billion worth, and a little more than a third of that is held in the 3 UK categories. So UK all companies, UK equity income, and UK smaller companies. So something like 220 billion of the 600 billion which is held by UK investors is held in the UK. Now, when you consider that the UK stock market represents about 6% of the total value of stock markets around the world, then that really is quite an extreme case of what we call home bias. Home bias is the tendency for us to favor our domestic market, and it happens all over the world, actually. It's not just in the UK. American investors tend to hold more American shares. Australian investors tend to hold more Australian shares and funds. So it's understandable why people should do it. We like to invest in what we're familiar with, but it's also rather risky as well. And one of the mantras which we have at Fidelity is about diversification. You need to be well diversified between asset classes, between geographies, and an excessive bias towards the home market is clearly not part of that. It's a case of not putting all your eggs in one basket. Now, the fact that we own too many UK shares from a sort of structural perspective is one thing. It's not a reason, though, to dismiss the idea of investing in the UK market from a tactical point of view if there is a valuation argument for doing so. To do so, though, to have a bias towards UK shares actually would put you in a minority from a tactical perspective at the moment. Bank of America Merrill Lynch runs a monthly survey in which they ask investors where they're investing, where they're planning to invest, and for the last several months, really for several years actually, the UK has been one of the least favored markets. The latest survey shows that the UK is the most underweight region for professional investors. Some overseas investors have described the UK as being uninvestable. Uninvestable because there is so much uncertainty, so much political confusion at the moment, and other worries, economic worries, such as low productivity. Now, you don't need to be a genius to work out where that uncertainty is coming from. The twists and turns of the Brexit saga in recent months have been hard enough to follow if you're here and if you're particularly interested in parliamentary process. For most people, they're just not that interested. And if you think about it, if you're an overseas investor, if you're investing from New York or from Singapore, then you probably think it's just not worth the bandwidth, it's not worth the effort involved in getting to know what is really going on in Westminster at the moment. Now, there are people in this room who think that Brexit is a good idea. There are people in this room that think that Brexit is a bad idea. I think probably what we would all agree on is that where we are now is not where you would choose to be. If you think that we should stay in the European Union, you probably think that the compromise that we're edging towards is a rather grubby, messy compromise that actually is worse than staying in the EU. If you think that Brexit is a good idea, you probably think that the grubby compromise in the middle is not where you want to be. So it's quite an achievement after 3 years to have ended up in a situation where, by trying to please everyone, the Prime Minister has ended up pleasing no one. So the fact of the matter is that the UK's political situation is just one reason why many investors, particularly overseas investors, think it's really just not worth the candle of investing in the UK. Here's another reason why foreign investors are probably not so interested in investing in the UK at the moment. So as you can see, this is a pie chart which shows the weighting of stock market assets around the world in terms of their value. As you can see, more than half of the global stock market value is in the United States. Europe, another 14%, emerging markets, another 12%, Japan, 7%. Britain, as I said earlier, accounts for just 6% of the value of global stock markets. So if you're an investor in New York, an investor in Singapore, you're probably thinking, do you know what? I can actually just ignore the UK. It's not going to make a difference. If I'm a global investor, I can't afford to ignore the US. I probably can't afford to ignore a certain segment of the US market, you know, the FANGs, for example. I have to have a view on whether to invest in the FANGs. I probably don't need to have a view on whether to invest in the UK market. So that's a second reason why investors might not be interested in investing in the UK. Here's a third reason why you might not be interested in investing in the UK. The performance of the UK market in recent years, this chart shows the last 5 years' performance, has been pretty woeful. It's not been the worst. The line at the bottom, the orange line there, is actually Europe, ex-UK. So Europe combined, the UK and Europe, has been far and away the worst performing stock market or stock markets around the world. In fact, if you'd put £100 into the UK market 5 years ago, it would be worth something like £107, £108 today. If you'd put the same £100 into the US market, it would be worth about £150. The Tokyo market, £130, and the Chinese market, something like £178. So you can see that the UK has been a poorly performing market. So if you add it all up together, you've got political chaos, you've got a relatively unimportant market because it just doesn't account for that much of the global market, and you've got pretty poor performance. Why would you invest in the UK market? Well, here's why. Okay, so valuation. One of the consequences of investors, and especially overseas investors, just not being interested in investing in the UK is that the UK market has got progressively cheaper. And when you compare the valuation of the UK stock market with its peers around the world, you can see from this chart, on whatever measure you really choose to use, and the two measures here with the dark blue bands are the plain vanilla PE ratio, the price of shares compared to their earnings, and the light blue lines are the underlying earnings when you strip out the effect of interest and tax, depreciation, amortization, those kinds of things. So it's a kind of purer measure, and it makes comparisons between countries rather easier. And you can see on that measure in particular, the underlying profitability of the UK, the valuation of the UK market is extremely cheap. Something like half the value of the US market on that basis, and considerably cheaper than Europe and Asia and Japan on that. Let me just hop back. Yeah. So it's not just by comparison with other markets that the UK has got cheap. It's got progressively cheap against global markets as a whole, and it's happened progressively over the last 3 years since we had the EU referendum. You can see that it's been a steady underperformance for the last 3 years. There have been little upticks when people have got more enthusiastic about the outlook, but they've tended not to last very long. Okay, so cheap by comparison with other markets, cheap too against our own history. So if you look at the left-hand chart here, this shows both the FTSE 100, the dark blue line, and the FTSE 250, the light blue line. And this is a measure of the forward PE. So this is a measure of the price of the market compared to expected earnings, the earnings which analysts expect to be achieved. And you can see from this is a long-term chart, this is a 20-year chart, and you can see that where we are at the moment, the valuation of the UK market is pretty much where we were in 2003. Now, if you remember 2003, that was at the bottom of the bursting of the dot-com bubble. So we'd had a falling market for 2 years, and the market was the same price then as it is today in terms of a multiple of profits. Now, it's been cheaper. Yes, it has been cheaper. 10 years ago, in the wake of the financial crisis, the UK stock market was considerably cheaper than it is today. It's been more expensive. In 2014, 2015, the market was more expensive. But now, it's pretty much in line with how it was 15 years ago at a very gloomy time for the UK market. So that's on earnings. If you look at the valuation of the UK market in terms by looking at the dividend yield, so income, I think it's even more attractive. So you can see this again is a chart over the same period. It's over a roughly 20-year period. And you can see that apart from the brief spike at the time of the financial crisis, when share prices plunged and therefore dividend yields rose, apart from that spike, UK shares are offering a higher income today than they have done at any point over the last 20 years. And I actually prefer the dividend yield as a measure of value because it's about real cash. It's about what you receive into your bank account from the shares that you invest in. Earnings can be fudged by companies, or they're dependent on forecasts which are unreliable. The dividend yield is real. It's real, tangible cash. So I think that's a very interesting valuation. And if you compare the valuation of UK shares, not just with our history, but also with the other places that you can put your money to work, again, shares look pretty attractive. So what this chart shows is the comparison of the dividend yield on the FTSE 100, which is about 4.5% at the moment, with the income that you can receive by putting it in a deposit account, so cash, investing in government bonds, safe but rather low yielding, and corporate credit, so bonds issued by companies. In all of those cases, you're getting a much more attractive income from investing in UK stocks. And it's worth remembering that the income from a share tends to grow over time. Typically, you would expect the income yield on a share to be lower than a fixed income because it has the ability to grow. But now, not only are you getting a higher initial yield, but you are also likely to see growth in that yield. So I think there's a strong income argument for investing in shares. Now, why does it matter to buy cheap? Well, this chart, I think, demonstrates really clearly why it matters. There is a very clear correlation, a link between the price that you pay for an investment at the outset, when you buy it, and the eventual return that you achieve with that investment. It's an inverse link, so the cheaper you buy, the lower the valuation when you buy, the better the expected return. And this chart shows it very clearly. It's got 3 different measures. One's valuing a share on the basis of its assets, one's on the basis of its earnings, and one's on the basis of its cash flow. They really all tell the same story. And the 10 groups of columns here basically show the level at which you are buying. So the cheapest is number 10, the most expensive is number 1. And as you can see, on average, the cheaper you buy the share, then the better the long-term return that you can anticipate to get from that investment. Now, of course, at the individual level, this doesn't hold true. There are plenty of situations where, a relatively expensive share can do well and a relatively cheap share can do badly because there's a good reason why the share is cheap or there's a good reason why the share is relatively expensive. At the individual level, it doesn't hold true, but on average, in aggregate, it absolutely does hold true. Buy cheap and you can expect a better return. So it's good news that the market, the UK market, is cheap at the moment. Now, let's just look at this in a different way. So what does it matter that the market is cheap if there's a good reason why it's cheap? If the UK economy is in bad shape, and if UK companies are not able to grow their earnings because the economy is in bad shape, then you would expect the market to be cheap, and it isn't actually a good thing that it's cheap. I don't think that's the case, actually. If you look at some of these charts, you can see that the GDP growth in the UK economy is okay. It's not very good, and it certainly isn't as good as it was 3 or 4 years ago, but it's okay, it's positive. The UK economy is ticking along pretty nicely. The jobs market in the UK is actually in fine fettle. The unemployment rate in the UK has not been as low as it is today since the 1970s. Wage growth is pretty good. Inflation is running at about 2%. Wage growth is running at a little over 3%. So people's incomes are actually getting progressively higher in real inflation-adjusted terms. So I don't think the health or the state of the economy is a particular justification for the relatively low valuation of the UK stock market at the moment. What about corporate earnings? How are companies doing? Well, again, they're not doing too badly. So these figures were taken from Goldman Sachs. They track and they analyze all the company results from UK companies. And what this shows is that both on an earnings basis and on a sales basis, most companies in the latest 3-month period, so that's covering the final 3 months of 2018, were pretty much in line with expectations, 61% in terms of earnings. 22% actually beat expectations, and only 16% disappointed. So the vast majority of companies are actually delivering on investors' expectations at the moment. One other point to make about the UK stock market is that it absolutely is not equivalent to the UK economy. And I think these two pie charts demonstrate that really clearly. The one on the left-hand side is the FTSE 100. The one on the right-hand side is the FTSE 250. And what it shows is the proportion of sales for companies in those indices in various markets around the world. So you can see that among the FTSE 100, only a quarter of sales are actually made in the UK. 3/4 of sales are made in the rest of the world. And even in the FTSE 250, which many people say is a much more domestically focused market, it is much more linked to the health of the UK economy, even there, only half of sales are actually made in the UK. The other half are made outside the UK. So if you're investing in the UK market, you're not even that exposed to the health of the UK economy. So, just thinking about, I think I've made the case then that there is a valuation argument for investing in the UK. What about the areas which are of interest? I think there is so much uncertainty around, and there will continue to be uncertainty, because let's face it, all this argument about the withdrawal agreement, we haven't even started to talk about what the future relationship with Europe and the rest of the world is going to look like. We have got many months and probably years of uncertainty ahead of us. So given that, I would be very balanced in my approach. I'd be very balanced between growth-focused companies and value-focused companies. I'd be very balanced between defensive companies and more cyclical companies. I'd be balanced between domestically focused companies and internationally focused companies. Diversification, terribly important. However, I do think that there is probably a contrarian attraction of a number of sectors at the moment, because they have been fairly beaten up. And one which jumps out at me is the real estate market. Now, there are good reasons why real estate is performing badly. In particular, real estate which is linked to the retail market. We've heard at an earlier talk this morning, I don't know whether you heard it, about the structural problems facing the retail sector in the UK. So there are reasons, but there is such a wide discount between the value of real estate-related shares and the underlying value of their assets, that actually I think there's beginning to be some value emerging there. There are some sectors which I actually wouldn't touch at the moment. Banking is a good example. For banking to be profitable, for banks to be profitable, you need higher interest rates than we've got now. Banks basically earn their money on the gap between the interest rate at which they lend money out and the interest rate at which they borrow money. And if interest rates are very low, it's very difficult for banks to capture that gap because it's so fine. So banks, I think, are going to struggle as long as interest rates remain low, and I'm afraid that their interest rates are going to remain very low in the UK for a very long time. The oil and gas sector, though, I think is looking actually quite interesting. We've seen a big rise in the oil price so far this year, and crucially, oil and gas companies like BP and Shell, have become much more efficient at driving profitability from their assets. They've cut costs, and they've become much leaner, stronger businesses than they were. In fact, the oil and gas business is more profitable at $70 a barrel oil than it was at $100 a barrel oil just a few years ago. So it's able to generate profits, it's able to generate cash flow, and crucially, it's able to pay high dividend yields, particularly, in fact, because many of its dividends are paid in dollars, and the weakness of the pound has made those dollar dividends more valuable. So, where to invest in the UK? So I hope I've made a reasonably strong case for investing in the UK. At Fidelity, we have a list of our favorite funds. It's called the Select 50. And we have a number of very good UK funds on that list. Some of them are here. Ones I would just draw your attention to. We've just come to the end of the tax year end investing season, so this is bang up to date information. The most popular funds that we've sold in ISA season at Fidelity are the Linsell Train funds, both the UK equity fund and the global equity fund. It's a very focused, concentrated fund. It's probably got about 25 different stocks. It's got a real quality focus. Nick Train, who runs the fund, has got a fantastic track record. That's one fund which I particularly like. And in fact, from a personal point of view, it's my biggest holding in my own personal portfolio. Very good fund. Quite a different fund, but also an extremely strong fund, is the Fidelity Special Situations Fund. So this is run by Alex Wright. Completely different approach from Nick Train. Nick Train focuses on quality and just a small number of high-quality stocks. Alex Wright is much more of a contrarian investor. He looks for stocks which other investors are just not interested in. They're out of favor, but he sees a reason for them to bounce back. So the Special Situations Fund is a value fund, a contrarian fund. Quite different, but equally high quality. His approach actually is shared by Alistair Mundy, who works at Investec. He runs a few open-ended funds, but he also runs the Temple Bar Investment Trust. Very contrarian. He jokes about rummaging around in dustbins to find the stocks which no one else is interested in buying. If you believe what I say about the health of the UK economy and about the low valuations of UK stocks, then you're probably going to be interested in the mid-cap area and the small-cap area. The Threadneedle UK Mid 250 Fund is an excellent mid-cap fund. That's on our Select 50. I've also got a lot of admiration for Gervais Williams, who runs the Miton UK Smaller Company Fund. And if you believe what I say about income and the income attractions of UK shares, then I think there's an argument for an equity income fund as well. And the Jocham UK Equity Income Fund is a very good fund, and again, on our Select 50 list. So I think there are 6 funds here which are a really useful way into the UK market for anyone who is interested. So there we are. That's my case for investing in the UK. I do think that we do suffer from home bias in this country, but I think at the moment there is a very strong argument for saying that home bias has never been more sensible. So thank you very much for your time. Please do visit the Fidelity stand, and please do come to fidelity.co.uk on Tuesday at midday and ask me any questions you like on any markets around the world. Thank you for your time.